The broadcast is now starting. All attendees are in listen-only mode.
Welcome to today's webinar. I'm Andrew Fake and I head up content for Minds and Money. Before we start, a couple of housekeeping comments. The webinar is scheduled to run for 45 minutes. All registrants will receive a copy of the recording of this webinar via email. You can ask questions at any time by using the questions tab in the Go To webinar on your screen. And if you experience any trouble with sound, we recommend that you exit the webinar and then log in back again. I'd just like to give a brief introduction to the topic and today's webinar panelists. Today's webinar is called "Is Public Equity Financing Dead?" And to debate some of these issues involved, we are joined by Bert Koth, Managing Director and Partner of Denham Capital. Bert is Managing Director and Partner responsible for origination, analysis, structuring and execution of investments for the mining deal team. He brings over 21 years of experience to the firm and is a member of the Fund Investment Committee. Michael White is President and CEO of IB Capital. He's been with IB Capital since 1990. During this time, Michael has been involved in private placement financings totaling over $600 million. He is especially an expert in the junior mine financing space. Peter Grosskopf is Chief Executive Officer of Sprott. Peter brings more than 30 years of experience in the financial services industry. At Sprott, he is responsible for strategy and manages the firm's investment capital and lending business. And last but by no means least, we're joined by Michael Pickersgill, partner with Tories. Michael is a partner and co-head of Tories Mining and Metals practice. His practice focuses on corporate and securities law with an emphasis on corporate finance and mergers and acquisitions. So a warm welcome to our four panelists. And without further ado, I'd like to go and dive straight into the questions. And my opening question is for Michael White at IBK. At the PDAC convention earlier this year, there was a report produced on mining finance called At the Crossroads. Michael, can you perhaps remind the listeners as to what the crossroad referred to? And has the industry chosen a particular financing road in the 8 months since that report was published?
Oh, hi, Andrew. Can you hear me?
Yes, you can.
Wonderful. Yeah, that was a report that was put out by the PDAC just in advance of their annual conference, which is in March each year. The report, which came out in late February, basically showed that global funding for exploration financing dropped 50% year over year. So 2018 versus 2017, the funding for exploration had dropped 50%. There were some other details in that report. It showed that financing in Canada for exploration had dropped by 25%, but still a significant drop. And I think the PDAC was basically trying to highlight in this report that a critical aspect to mining, of course, is replenishment of reserves and resources. And in a world that continues to grow and continues to have an insatiable appetite for metals, whether it be precious metals or base metals, battery metals, however you want to categorize them, when you have a globe that's growing and a need that continues to grow for these metals, if you're not replacing the resources and reserves that are ultimately mined to produce the metals, then you have an industry that's strained, and will be strained on the supply side. And if we're not spending the money that's necessary to replace these reserves, then you run into difficulty if you look out over the long term. And it's kind of a conundrum that you find yourself in. How is it that an industry cannot be replacing its reserves? So, at the crossroads, I guess, your question now is, if we're not able to fund these exploration the necessary exploration using equity financing. How has the landscape changed, and how will we fund them going forward? I have to say I don't think that equity financing for exploration and development, early stage through to mine development, equity financing in mining is dead. I think that's a very harsh word to use, and I'll just start this webinar out with that. By no means is it dead. Certainly, as you move through the cyclical nature of mining and mine finance and mine investment, the earlier stage projects, the riskier projects, tend to be the ones that suffer the most, and the ones that take a little bit longer to come back. And therefore, it's not unusual to see a drop in, say, equity financings for exploration or earlier stage development. This may have been a particularly difficult drop, but there's a background to it, and there are reasons for it. And certainly one that you can point to is cannabis in Canada, and to a certain extent down in the United States and in other jurisdictions globally. An awful lot of early stage money. What I mean by that is a risk reward profile that's similar to an investment in, say, exploration, where you have a lot of risk, but you also have a lot of potential reward. Those dollars, equity dollars, moved into the cannabis space. And it's not unlike what we saw in 2000, 1998, 99, 2000, when you had an awful lot of dollars moving into what was then called the dot-com boom. So yes, things have shifted, and it is difficult, I should say, to find money for these early stage mineral exploration ventures, but the money is there. And it's seeking right now situations where there's a lot of upside potential, that's backed by very good teams, and that has a quality, and I'll just loosely call it a quality in terms of grade. So that if the discovery that's the encouragement that's at hand can be developed and can grow and turn into something that possibly could develop into a mine, it'll be of a high quality. And money's moving towards that. There are also alternatives to equity financings, and this is a little bit further along the exploration development curve towards development, but we've seen an awful lot of money come into the market through other vehicles like streaming. In no means would I say that equity financings are dead. We did see a bit of a hiccup there in 2018 on the back of 2017. But we're starting to see a revival now coming through 2019. We've had an improvement in precious metals, particular gold, and in silver. We have some other metals like nickel, which are tied to electric vehicles. The price of nickel has performed very well, and therefore, and again, this is pretty standard stuff when you're transitioning from a bear market to a bull market. You need that. You need the underlying metal to have an improvement in value, but more importantly, stability. And I think with the improvement that we've seen in gold and silver in terms of appreciation of value, the same for nickel. As long as we can see some stability in those prices, and they're still quite volatile, but if we can start to see some stability, then that will help move more money into the sector, and that money will trickle down to the earlier stages of the sector. Okay. So we've made a nice, we're transitioning, I think. We're transitioning in a way that you would expect from a bear to a bull market in metals and mining.
Okay. So perhaps just turning to the other Michael, in your opinion, how have things changed for the equity finance and public equity finance markets this year? What are the key trends that you've noticed?
Yeah, thanks, Andrew, and good morning, everyone. I mean, I would at the outset just echo a comment that Mike White had said there, which is that I think the good news is that the public markets, are not dead for the mining sector, and I think equity is still playing an important role, albeit one that has changed over the course of the past 4 or 5 years, and introduced a more nuanced role within the overall capital stack, and some of the other speakers and some of the topics later in the webinar, I'll touch on those things. I think there are a couple themes coming out of the capital markets in the mineral sector this year that I'll touch on really briefly. The first one is, as Mike alluded to a minute ago, you do see a bit of an odd series of trends in the market activity this year. On the one hand, speaking as a Canadian capital markets lawyer, who's focused naturally then on companies listed on the Toronto Stock Exchange, which is a precious metals heavy exchange, you do see that the gold index has done well. The gold company index on the TSX has at least over the first 3 quarters of 2019 was up somewhere in the order of 35% on the back of strong gold prices and precious metals more generally. What's interesting is that is not translated into significant new issuances and initial public offerings. And I think what's intriguing about that is that it's happened in the face of headwinds in some of the other sectors that have attracted generalist investors. So we've seen this year, obviously, cannabis still attracts risk capital. But that industry has started to run into what some might have thought as inevitable headwinds and governance issues as it started to mature. We've also seen, the crypto market is one that's come off, and technology has also had a few challenges in terms of some of the performance of the publicly listed entities. And notwithstanding that, and notwithstanding some of the long-term demand and supply mechanics, which should support the market. As Michael was alluding to earlier, we've seen mining companies struggle to raise new issuances. And I think that's just a sign that the generalist investor is slow to return to the sector and looking for either highly risk opportunities that provide the right risk metrics and matrix, or also established names through existing listed companies in the secondary market. And that's partially why we've seen trading in existing names strong while new issuances have been slow. I think there's just one other theme that is an interesting one, and we've noticed in the capital markets, and one we've been fortunate enough to participate in here heavily at Torys is not just the surge of alternative financing tools, which we'll talk about a little bit in the next section, but also how the royalty and streaming companies themselves have played a significant role in capital markets activity this year. So we've seen the participants in that industry using the capital markets to raise capital through some novel means. Franco-Nevada recently launched an at-the-market offering tool, which allows them to access the capital markets on an effectively ongoing basis, and they've raised $100 million through regular market sales under that program this year. We've seen Orion Resource Partners utilize the capital markets in partnership and working closely with Cisco. As folks may know, when Orion sold its royalty initial portfolio to Cisco, it retained a large stake in Cisco. It ultimately monetized that stake in a fairly complicated transaction, but which involved a large equity financing early this year. So they used a prospectus public marketed transaction to exit their equity stake in Cisco, and that was quite a successful transaction, a successfully and fully placed bought deal earlier this year. So you see other royalty and streaming companies looking to enter the market and to utilize the capital markets as well, which we've been lucky enough to be involved in. I think the other last theme I would just mention is, the equity capital markets, because of the role that equity now plays, usually on the project development and exploration side, as part of a more complicated capital stack, or because of the demands of the capital markets right now and some of the challenges for issuances, it really requires creative deal making. And all of those transactions I just mentioned were not the bought deal of yesteryear, where equity could simply be rolled out at the appropriate time. Instead, it really needs to be part of an overall strategic story in order for investors to purchase new issues.
So, moving on to Bert. Obviously, Bert, you work for Denham Capital, one of the leading private equity investors within the mining space. Do you think that the public equity markets are on a retreat, and if so, why? And what possible lessons can be learned?
Well, I mean, if the question is why is kind of equity raising compromised, by the way, I mean, I agree with prior statements that the equity markets are not dead, but they certainly appear quite diminished compared to what they have been before. In our opinion, there are several reasons for that. There are reasons that are completely outside the mining company's control. For example, there's a political macroeconomic overlay that you have at the moment, like, for example, the trade war, the ideological rivalry between China and the US, and all of that creates a lot of volatility, and there's a very good chance that that volatility is going to stay with us for quite a while. So first of all, there's a macroeconomic overlay here that is beyond the market participants' control. The second reason is when you look at the end of the super cycle, according to our rough estimates, between 700 and 800 billion US dollars were lost in the metals and mining industry, share price losses, impairment charges, projects that didn't work out, acquisitions that didn't work out. So that's a significant amount of money lost. And obviously, when such an amount of money is getting lost, investors are being nervous and they're more careful next time around. And right now is next time round. So therefore, the companies that seek to raise capital on the public markets or on the private markets, for that matter, encounter a much more careful and more risk-averse audience. So that shouldn't be a surprise. Thirdly, I would say, especially on the retail investor side, and this might be specific to Australia, I cannot really comment on Canada here, is there also seems to be a structural change in the market, in that a lot of the high net wealth punters who, as retail investors, say 10, 12 years ago, were rolling the dice like $5 million, $10 million each. A lot of these individuals are now in the 70s and 80s and late 60s and are therefore economically retiring from investing. It's something a lot of brokers here in Perth, where I live, tell me regularly, Bert, 8-9 years ago, we had a roadshow and we had 40, 50 people in the room, and most of these 40, 50 people each could roll the dice for $5 million. Today, if we go out on a roadshow, we're happy if we have 8, 9, or 10 people in the room, and they can maybe roll the dice for $2 million each. So there also seems to be, on the public markets in Australia, on the retail investor side, there seems to be a structural change, a generational change, and seemingly the younger people who have money, they seem far less interested in mining. They seem more interested in fintech, in responsible investing. So amongst the younger ones, there's far less interest in metals and mining. So there's not one reason. Why equity raising is compromised. There's several reasons. And also, I mean, a comment on the private markets. I mean, clearly, private capital providers play a much more important role in financing industry today than typical public market investors. But it also has to be said that amongst many of the private firms that are supposedly specialized in investing in this space, a lot of those have catastrophic portfolio losses. So again, obviously no names here, but there are some specialized mining funds out there that have lost between 50 and 60% of their portfolio values. So therefore, also, while the public markets have suffered significant losses, there are also significant pools of private investment capital who have actually suffered significant losses. So therefore, yeah, there's less appetite today. I mean, it might be slowly coming back Obviously, we might be wrong. Nobody has a crystal ball. But at least from our perspective, we cannot see this coming back anywhere close to where it was several years ago. But that's our opinion.
Thank you very much for that, Bert. Turning to you, Peter, I'm going to probably roll two questions into one here. I guess kind of the first bit is your sort of perspectives on the decline in equity financing for exploration over the last few years. But perhaps within your answer, you could also expand a little bit about Sprott and specifically Eric Sprott's 217-6423 vehicle, because that's obviously been making a lot of headlines this year in the mining investments that it's been doing.
Sure. Well, good morning, everyone. I think the decline in exploration company interest has been part of the collision of two very large-scale trends. The first and more obvious to those listening on the phone is the bear market, which took most exploration stocks down from top to bottom by somewhere between 60 and 90% between 2011 and 2016. As Bert mentioned, that's left a lot of people feeling burned. And secondly, and maybe not so obvious to those focusing only on the mining sector, is there's been within the asset management industry a pervasive move to indexation, and there's collateral damage that comes from that indexation, which affects sector funds of every variety in every sector, which is that they've just become extremely unpopular. So every fund needs to justify its fee loads, and when you take a look at the fee loads of specialty mining funds, they can't be justified by the Sharpe ratios that have been created by those funds. So just from a technical portfolio management perspective, investors look at them and say, if I want that trend, if I'm betting on a resurgence in exploration spending, I'm going to play it through the index. And of course, the index in our sector is actually dominated by large cap companies, and even the GDXJ is not really a small cap index anymore. So I think that's affected everybody on the phone today. Second part of your question, in terms of how Eric is perceiving this market, and I don't want to speak for him necessarily because he does operate a completely independent family office from Sprott, although we do some things together. I would say that, to use his own words, Eric's favorite strategy has always been to steal value. And what he sees in this sector is that first of all, it's largely ignored by generalists and retail investors now. So there are exploration stocks that trade at pennies on the dollar of value. And it's Eric's job, the way he sees it, in his mandate and his strategy, to go around and steal that value. So he goes in now, he's got a very large equity book of his own, and he makes proposals to finance these companies. And in making those proposals, he somewhat validates their thesis then, because they now have enough money to go prove it. And so that's been a very successful strategy. I would add that we've deployed at Sprott probably several $100 million in exploration stories over the last 6 to 8 months. So we certainly have been very busy doing something similar as well. And think that the underlying themes are that majors will eventually have to address reserve depletion, and they say they're not going to buy anything, and they say that for very good reasons, because their shareholders have focused them on capital efficiency, and so no CEO in the mining business is going to get a bonus this year by going around and saying he's going to buy a bunch of things. But the math is too compelling for them to avoid in the long run, I think. So they might be saying it in the short run, but in the long run, when the cost of capital of a major mining company is in the 5% range, which it is now, and the cost of an average high-quality development project is 15%, you cannot ignore that math
for more than a few years. So we think they are going to buy. And the junior companies right now are, in select cases, developing commercial deposits for between $5 and $25 per ounce of discovery. And with the gold price, especially in Canadian and Australian dollars, being at $2,000, that margin is massive. So the value creation through successful discovery is huge. And that's why you have got individual exploration stocks really beating everything in this market now, is because when they're onto something commercial, investors know they're never going to make a better return than being invested in one that works, and creating a portfolio of them also works right now.
Thank you very much for that, Peter. I think that at this juncture, we'll move on to the first poll of today's webinar that will be shortly coming up on your screens. And we'd obviously invite everyone to go and vote. And the polling question is, are traditional types of equity financing dead? You've got 5 options there: strongly agree, slightly agree, unsure, slightly disagree, or strongly disagree. Whilst we're all allowing you to go and vote, I'd like to sort of move on to alternatives to equity financing, and perhaps sort of ask a question to Michael White about debt financing. Debt financing is the traditional funding method for more advanced stage projects and larger companies. Has it become more available for exploration, or if not, what sort of like needs to change?
Yeah, hi. Yeah, we at IBK Capital, we deal in the small cap, junior cap market space. Equity. At times through the cycle, you may have a shift where a company that has an exploration portfolio that's quite robust goes out and is able to finance through some sort of quasi-equity instrument like a convertible debenture. But we found that traditionally over time, that space is almost exclusively financed by equity financings, but also through project finance or financing at the project level, and usually in the form of joint ventures. So in the past, in a bull market, when money is readily available, these junior exploration companies will almost exclusively finance through equity. It's readily available, and we've also seen a trend from the brokered financing to the non-brokered financing, and that seemed to be at the end of the last cycle. About 90% of money that was being raised was equity for exploration companies on a non-brokered basis. Transition into the bear market, and as we just heard, you have this fall off in value for up to 90% in some cases, and raising financing becomes more challenging for these companies if they're looking at the equity route. And that's because even if they have a good project and they have, say, a community or a network that's willing to finance them, whether it be friends and family or high net worth individuals, or just access to certain institutions that may want to finance them, their valuations are so low that it's difficult to raise any appreciable amount of money without greatly affecting the value to current shareholders because of that dilution. So they have to look to alternatives. And in the early stage exploration space, those alternatives are few and far between, and it's usually on the project level. So we have seen an increase in terms of clients coming to us, in terms of junior exploration companies coming to us. We have seen over the last couple of years an increase, an uptick in these companies saying, okay, find me a partner for these projects. And that's the way we're going to finance, project X, Y, and Z. the money that we're able to raise, the small amounts of equity, will reserve for project C. And it's usually a case where they've got a portfolio and they've made the decision that certain assets are available to be diluted at the project level, so therefore find us a partner. And that partner can come in many different shapes and forms. It doesn't have to be an industry partner. It can be it could be a private equity group. It could be other forms of capital. But you've got a mix, and it's at the project level, and then they're reserving their dollars that they can raise on an equity by way of equity for those projects that they want to maintain 100% control of. So we have seen that transition, and we see it continuing through this year and into next year. But as the bull market comes back, and as these, and it's on a select basis right now, but as these equities begin to perform, and as we just heard, it's the performance of a junior equity stock can be quite breathtaking, as Peter pointed out. Then I think we'll see a transition back to the more traditional bull market financing, where it's pure equity, and the company goes out, raises that equity, and uses that equity to explore. I'll also just quickly add that in Canada, and this is particular to Canada, we do have a fairly robust flow-through program. It's a tax incentive for folks that want to invest in exploration in Canada to invest through equity by way of purchasing a flow-through share. They can then take that cost and reduce their taxes payable at the end of the year. Although we've seen a bit of a transition in terms of equity financings and flow through, more on the personal level and less at the institutional level, money is still available in Canada, and I think that's what sheltered Canada in terms of the PDAC report, the Crossroads report, where our financings dropped by 25% rather than 50% globally. That's because we have a very robust flow-through program in Canada, and that's still alive today. It's not as well as it used to be in the past. There aren't as many dollars going into it, but it is absolutely a vehicle that's being used to fund exploration in Canada.
Okay, thank you very much for that, Michael. I think we can now have the results of the poll up on the screen. So in terms of answering the question is, are traditional types of equity financing dead? We had 31% slightly agree, 31% unsure, 25% slightly disagree, and 13% strongly disagree. We'll have another poll later on in the webinar. Turning back to yourself, Bert, we've obviously mentioned we've seen the growth of alternative funding solutions. How are these other funding methods, such as private equity, evolving?
Yeah, thanks, Andrew. Well, first of all, I mean, private equity in mining is doing what it's always been doing, basically. So I think the private equity product itself has not really changed at all. It's just kind of, in terms of percentage of what the overall funding mix, has become much more important, simply because the public markets are kind of provide much less capital than before, right? But first of all, I just want to clarify that actually private equity is not a very homogeneous product. It actually, I mean, there are 7-8 private equity firms of reasonable scales out there, and I shall say that's actually not a lot. Yeah. If I compare oil and gas private equity to metals and mining private equity, in oil and gas private equity in the US alone, you have $100 billion pool of capital. Yeah. And in metals and mining private equity globally, still available dry powder, you may have between $5 and $6 billion on a good day. Still available dry powder capital that's not yet committed. So as a starter, private equity in metals and mining is actually a relatively small pool of capital. And by the way, that I'm obviously as a private equity manager myself, lots of insights here, but I do not expect the pool of capital to grow materially. So, and within those, let's say 7-8 firms, there's actually quite a broad variety of investment strategies. There are firms that underwrite minority stakes in listed or private mining companies. That strategy is still out there, but there's less capital available for that strategy than there was before, because a lot of funds that engage in that strategy have actually suffered significant portfolio losses. But that strategy is still out there, but it's becoming less popular and less well regarded by the investors who actually underwrite these private equity firms. Then you got funds out there that are more like buyout funds that take over mining companies completely. So that's another group of funds. Then there's funds like us out there, who again have a very particular strategy. We start with the management teams, so we start with the people before the people have the assets, and then together with the people, we actually secure assets. So every fund's got a different strategy. So in terms of absolute deal volume and capital deployment, private equity has not grown as an asset class in mining, but it's percentage-wise kind of become more important now with less public market capital available. And then I think the real surprise is actually the very dramatic growth of alternative debt products for metals and mining. And it's certainly the first time in my career that we see a situation where it's actually easier to raise the debt than it is to raise the equity. But because previously, like 15, 20 years ago, you would raise like your 30% equity, and then you would go cap in hand to the various project finance banks, and you would say, "Dear Mr. Mrs. Project Finance, can I please have my project finance? Look, I raised my equity." Today it's just the other way around. There's quite a number of bankable projects out there that all have basically the debt sorted out, but they don't have the equity sorted out. There's very few projects that get funded on a 100% debt basis. So even when companies raise the debt 60, 70, sometimes up to 80%, they still need to find some equity usually. What we see now is actually that often the terms of the debt and the nature of the debt is such that it becomes impossible for the equity to come in. And as a result, quite a number of projects will actually end up being unfunded, despite the fact that the debt is actually available. And I say that because, for example, if a project has debt that commands a 20% IRR or a 22% IRR, then the debt takes too much of the economic buy of the project, and therefore there is no longer an economic rationale for the equity to come to play. And then the other thing is that we also see increasingly trade financing houses providing development capital for mining projects. But again, if the quid pro quo for providing that trade finance is, for example, that life of mine offtake goes to the trading house, then the company becomes less attractive for the equity to invest in, especially for private equity firms, because private equity firms like us typically make the money when the business is getting sold. So if the life of mine offtake is already given away to a trade financer, and the M&A attractiveness of that company has diminished dramatically, because most people would buy the business to lay their hands on the underlying metal. So if the metal is already spoken for, it becomes a less attractive takeover target, and therefore less interesting for private equity firm to invest into. So I would say over the last 12 months, the most surprising trends that we as private equity financiers observed was that it's often much easier to raise the debt than it is to raise the equity, but that the nature and the terms of the debt often make it impossible for the equity that is still required to come into the project to actually come and play.
Thank you very much for that, Bert. Just moving on to royalty and streaming, we kind of touched on it in the earlier part of the webinar. Peter, how do you see the royalty and streaming market evolve, and what innovations can we expect to see in the space perhaps over the next year?
Well, I should start by saying I'm not really an expert, but I would say that royalties and streams are being much more carefully considered by both shareholders and management teams, thankfully. because they are usually long-term in nature, and they are expensive from a cost of capital perspective, depending on the exact arrangement. So with that amount of margin going to service a stream, we've frequently encountered situations where it becomes problematic, and shareholders suffer as a result. I think rightfully so. Companies are now much more sensitive to issuing those instruments. I would say that on the capital side, the royalty and streaming companies have done very well. I think their model works. They have a longer term view. They do more due diligence. There's less volatility to their earnings. They have a higher margin than equity most of the time. And as a result, capital has flown into the sector. I think there are, at last count, when we added it up, end of last year, there was $50 billion, which has become quite substantial now in the context of the mining industry, chasing royalty deals. And it's evolving. So there are more players. There are more strategies within royalties now. There's exploration stage, there's financing stage, there's de-risk stage, which is now being participated in not just by royalty companies, but by institutional investors directly. And I think as a result of all of that, more capital chasing fewer deals that are being more, more conservatively given out, the structures are changing a bit. So now it's common to have buybacks on those royalties and streams, and it's common to have loans that are offered with them. And it's going to become common, I think, in the future for those facilities to be syndicated as opposed to all going to one participant. So it's quickly evolving into a market that, quite on its own, is sizable.
Mm-hmm. Michael, as in Michael Pickettskill, I note that private transactions and placements now exceed public offerings. Have they become the way forward? You know, what sort of trends can we expect to see over the next sort of few years?
Yeah, thanks, Andrew. And I think it's interesting to think about private placements and private transactions in the context of Bert's comments earlier and Peter's comments a moment ago. You know, I think to consider the role that private placement's playing, it's important to compartmentalize it a bit, because as Bert said, with respect to sort of traditional private equity, you're really talking about a variety of different vehicles and both sources and purposes of capital. And I think the private placement market is very much the same. In the first instance, there's an opportunity, and if you look at the capital raises done, in the Canadian capital markets over 2019, you will see a skew towards private placement fundraising, and some of this reflects the ability to access private pools of capital and the broader marketing, all reflecting the issue with the generalist investor that we've been discussing through the webinar. So I do think that's one alternative that is getting traction. I think it's also important to remember that a lot of the capital that is privately placed, so to speak, in lieu of traditional equity raises, is coming from two important sources and continues to. The first is, as Peter was alluding to there, is as part of a broader package, for complex alternative financing. So, significant equity stakes have been raised by companies in development, various stages of development, pre-production, where there is an equity component, a significant equity component, but that is very much part of a financing package that includes streaming and royalty financing and debt packages. So, there's a variety of different circumstances out there, but Lundin Gold is a perfect example of very large private capital injection in equity, but an equity injection that doesn't happen without the corresponding gold prepay loans that were done for the benefit of those equity investors. the other important source of private placement capital are the ongoing strategic stakes being taken in development companies, pre-production development companies, by the more senior or major gold and other metals companies. So you look at this strategy where strategic companies, operators themselves, are taking minority stakes, large minority stakes in existing public companies in order to fund development of projects. So there's examples of that abound. If you look at, just by way of an example, Continental Gold with its Beritica project in Colombia, that is funded in part by streaming financing, equity raise, but also by a large equity type investment from Newmont. So that source of capital also provides a lot of strength to the private capital, if you want, as opposed to private equity markets. But I think it's important when we think about private placements as the way forward. I think without doubt that as a source of equity on your balance sheet, finding private sources of equity, is very much one of the ways forward as an alternative to broadly marketed public equity raises.
One thing that was mentioned earlier was flow through shares. I think Michael White mentioned this in an earlier answer. Just turning back to yourself, Peter, they've obviously been extremely popular for years in Canada. Are they the saviour for junior company financing?
Yeah, so we're not aware of international markets other than Canada where the identical structure is available. We do know that it's as strong as ever in Canada, and that any company, whether foreign or Canadian, with an asset in Canada, I believe, can structure themselves to take advantage of Canadian flow-through issuance. Those tax credits need to be renounced to an investor through a very specific share structure. And so one may need to be created by a foreign company to take advantage of the regime in Canada, but the securities that are created with the deal could probably be made to be convertible into the parent company shares. So I think that any company with a project in Canada should consider the flow-through markets as being of interest. My own view on it, and the reason we've stuck with a flow-through fund through the bear markets of 2011 to 2017, was we think that in Canada it's one of the last remaining areas of government sanctioned tax shelter, and that actually every generalist investor in Canada should buy exploration stocks every year via that structure. For the life of me, I can't understand why it doesn't raise multiple billions, but here we are. I think eventually it will become even more popular than it is now. So it's been a great help to our industry. It creates jobs, employments, economic development. There's a very strong lobby to keep that structure in place. I don't think it's going anywhere, and I would encourage any foreign company with an operation in Canada to explore it if they don't have another efficient way of raising capital.
Okay. I think we're just going to move on to a couple of final questions, just looking at financing options at the development stage. Turning back to Michael Pickersgill first, can you just kind of give us briefly sort of like your view on the different financing options available at the development stage of a mining project?
Well, I'm happy to, Andrew, and I think what I would do, just with a kind of a view on the clock as well, is really a couple of remarks more broadly. I mean, these various tools, bridge financing, equipment financing, export credit availability, development finance, credit support, and offtake agreements. I mean, these are fundamentally all very different pieces. I think the key for companies is to understand that there is and again, I'm repeating myself, but I think the theme is critical, that all of these play a role in building the project financing structure, and each of them are very different. And companies will need to think about how to build that structure. As Bert alluded to earlier, the traditional order of financing has inverted over time. And so, the important structural consideration is the order in which one, for your particular project needs, particular project risks, obtains the overall financing package. And key, given the number of different tools available and the number of tools that may be required, given the constraints in the equity markets, there are a couple of key issues to bear in mind. The first is that, thinking about the long-term implications of some of these are critical, both from a costing and flexibility perspective, but also from the ability to obtain further capital. All of these come with different constraints. And so, just to use an obvious example, equipment financing comes with certain constraints on your secured structure. So thinking ahead about how intercreditor arrangements are going to work and how you're going to be able to roll out the different debt components is absolutely critical in a miner's thinking about financing.
Mm-hmm. And then, Bert, given this sort of difficult and changing financing scene, what are the challenges of securing financing during the mining development and construction phase? What, in your opinion, are the biggest pitfalls?
Well, the biggest pitfalls now are the same ones that would have been 5 years ago, the same as they would have been 10 years ago. The biggest pitfalls is lack of projects that genuinely stand up a rigorous due diligence, combined with a relative lack of people who really have it what it takes to deliver projects on time and on budget. I mean, the issue is I always say that's a simplification, but I always say there's two types of mining investors. There's people who just hunters who play on the public markets, and when the market momentum goes up, people make money. That's great. But then there's also investors like us who deploy the capital to make a project happen for real. And when you risk a lot of capital to make a project happen for real, then you have to due diligence the project from the perspective, what can go wrong when you actually build it? And when you look at a project that way, then you cannot be optimistic. You actually have to, the purpose of the due diligence then is to kill a project and to see what can go wrong. And if a number of things can go wrong, is the project then still economically viable, right? How many punches can it take? So as you peel the onion and say, how's the mineralogy? Is the metallurgical problem? Are there going to be difficult ground conditions where the commissioning is going to take several months more? Make no mistake, several months more of commissioning is usually millions and millions of additional working capital. So there's a very, very long list of risk items for every single project where actually things go wrong. And this is an industry that on average has between 25 and 30% capital overrun. And for every project that has such a capital overrun, there's a beautiful bankable feasibility study that says the project basically has a 10% margin of error or something like that. So this is an industry where things usually take longer and cost more than the owners of the project and the companies owning projects actually think they do. So first of all, a scarcity of projects that genuinely withstand a realistic and rigorous due diligence. And secondly, is really people. It's an industry that is very promotional. That's necessary in a capital-starved environment to raise capital. So those who scream loudest usually have a better chance to find the money. But the promotional nature of management then often translates into overconfidence and actually into optimism that's not realistic. For example, if obviously can't say the names, but if I look in our portfolio, the management teams who were the worst performers were actually the extremely confident people. So actually precisely those people who, for example, the public equity markets would say, well, that's a real go-getter. This is a real doer. So interestingly enough, a very high degree of confidence, very often actually translated into relatively poor execution. So we, for example, find that the people who are performing best are actually usually very boring technocrats who do things in a very kind of sequential fashion. Because in mining, you can actually take a lot of the risks off the table if you do things very patiently and with the right sequencing. But yeah, it's really, Andrew, it's on the development phase, and that's what we do as a fund. I mean, we assume the execution risk. So, and our strategy is basically with carefully selected management teams to take control of mining projects, bring them into production, and then sell them once they're up and running and producing. So, since that's what we do, we obviously have a lot of experience how the commissioning risk and how the execution risk on the journey to production looks like, that we assume with our investors' money and with our own private money. And yeah, on that part of the value curve, the risk is high, and the number of projects that really stand up to genuine scrutiny and the number of management teams who stand up to genuine scrutiny, they're both very scarce. I mean, to give you a statistic, I mean, in our fund, I mean, we have business plans with more than 300 management teams, and we've transacted with 8, and with those 8 management teams, we have screened in excess of 1,200 projects, and we transacted in 13.
Wow. I think that we've out of time, Bert. So I just in the interest of time, I need to thank you, Bert, Michael, and Peter. Thank you to all of our listeners for dialing in. We'll be covering the topic of equity financing in greater detail at our upcoming Minds and Money London event on the 25th to the 27th of November, where all of the panelists you heard today will be presenting. All listeners of this broadcast will be entitled to a discount by using the following code, which is MMLWeb, and you'll get a 15% discount. The Minds and Money London event takes place next week in 2 weeks' time, on the 25th to the 27th of November. And for more great news and content, please check out our Mining Beacon website at www.miningbeacon.com. Many thanks, and see you again soon.
Thank you.